Welcome to week 3. Week 3 is preparing accrual-based financial statements. Please note that word accrual-based. We are not doing cash-based financial statements. Cash-based financial statements are not preferred by GAAP. They strictly record cash coming in, cash going out, and that does not truly reflect the financial condition of the company. Accrual-based financial statements are based on these two principles, the revenue recognition principle and the matching principle, which is also called the expense recognition principle. The revenue recognition principle says that you recognize your revenue, and when I say recognize, I mean make your journal entry, get it on your books, on your financial statements, when it is earned, not when the cash changes hands. Two examples, unearned revenue and accrued revenue. Unearned revenue is when your customers pay you prior to you performing the work for them. Examples are subscriptions, insurance, and concert tickets. If you think about these three items, all of them are paid ahead of time. If you're buying a subscription for a magazine, you usually pay for it ahead of time. So if you're the company that's actually issuing that magazine, you're getting the money before you're providing the service, which is providing the magazine. The other option is accrued revenue. This is where you invoice your customers after you've done the work. So if you're at the end of the year, say the last week in December, and you do some work for some customers, but you don't send the invoice out till January, you still got to recognize that revenue in December, not in January. With the unearned revenue, if you get some subscription revenue and you have the cash in your bank account, you cannot recognize that as revenue until you actually provide the service or send out the magazines. The matching principle, basically the same thing except it's for expenses. Recognize your expenses when they are incurred. So you'll see this word incurred used a lot. Basically it's when you're actually using up the expense. Recognize it when you use it, not when the cash is exchanged. Examples are prepaid expenses and accrued expenses. Prepaid expenses are anything that you buy ahead of time. So a lot of times companies will pay for their insurance 12 months in advance. You do not recognize the insurance expense when you pay the policy. You recognize it as you use it. Supplies are usually bought ahead of time and kept in some type of supply inventory. You don't recognize the supply expense until you use it. Accrued expenses are when you've incurred expenses but haven't paid for them yet. So salaries are very common. Most of us work before we actually get paid. A lot of times you'll use utilities all month long, but you don't get the utility bill until after the end of the month. Taxes, every time you earn income you owe taxes on it, but you probably don't pay those taxes until April 15th. So those are expenses that you've got to recognize when you use them, not when you pay for them. So if you can understand these two core principles, revenue recognition and matching principle, you will understand accrual accounting. One other item in week 3, way down at the bottom of the outline, is ratio analysis. So ratio analysis really, week 3 says preparing financial statements. Ratio analysis really interpreting or analyzing those financial statements. And it's, if you like math, you'll like it because ratios are plugging numbers into a formula. So this formula for the accounts receivable turnover is just net credit sales divided by average accounts receivable. So if you take your credit sales off the income statement, take your receivables off the balance sheet, plug it in this formula, you get that ratio. Now the important part about ratios is understanding what they mean. So for this one example, the accounts receivable turnover just tells the company how quickly they are collecting their receivables, which is very important for cash flow purposes. So that part of this week is fairly straightforward as far as the work is concerned, but it'd be great if you understood what each one of those ratios means. That's all I have for an introduction. Please ask any questions in the discussion forum. Thank you.